Yo, what's the dealio, man? Listen, you already know I got a straight banger for you today, all right? So, in this video, what I'm gonna talk about is we're gonna be talking about expiration dates and short term trading, right? So, when I was newer and I started getting my bag up, what I started doing was I started like swing trading 3 to 6 months out, right? And over time, I started doing closer expirations. And at this point, I just like trading weekly expirations, right? So we're gonna dive into that. So if you guys are watching this, be sure to like this video, subscribe to the YouTube channel, okay? And also remember, none of this is financial advice. If you want professional financial advice, go talk to a licensed financial advisor. All right, so let's get into it. So expiration dates, right? So when we're thinking about it, this all it got sparked from a live I was doing a couple days ago. All right, somebody said that they got into a trade and they got into like March expirations, and then they made like 12%, and then they got out. And I had mentioned, I was like, you didn't have to go that far out for your expiration date, right? And I know you guys probably heard me say this quite often on my lives, is you don't have to go far out of like expiration date. I recommend trading weeklies or the next week, depending on what day of the week it is. Okay, and I'm gonna break down for you exactly why. Now, everybody has their own way and their own method, right? Now, here's also what I'm saying. There's a negative connotation when it comes to short-term trader, right? Because just because you are a short-term trader, meaning that you are trading weekly contracts, doesn't mean that you can't swing trade long-term, right? But what I want you to understand is when you learn and understand short-term trading, what happens is you don't have to wait for the money as long, right? You don't have to be as patient, okay, for your target to hit. And so once you understand this concept, what you're probably going to end up doing is go get separate accounts for your long-term swings and your short-term swings and your day trades. All right? So now that we laid the foundation, let's go get into it. So I'm going to give you guys an example. Last year, I remember I was trading Coinbase a lot. Okay, I was trading Coinbase a lot. And this was when I really started to understand. I took a big L, right? Almost 20K. Now, I got into Coinbase in 2 different trades. I got 2 contracts each trade, in each account, and all the contracts was like 7K each, right? So I put like 30K into Coinbase. Now this was in like November. I had got expiration dates all the way out to like March. Okay, so I made that month, I netted like 40. I was up that month like 60, right? But with Coinbase, I ended up losing 17, right? Now let's think about this real quick. It was because I got so far out expirations, right? And then what happened was my analysis at the time, I was being too greedy. That's really what it boils down to. I was being way too greedy. Okay. But if I would have just got weekly contracts, I would have only ended up putting like, let's just say 4 grand in the trade, right? Let's be generous and say 5K. So if I would have took the same percentage L that I took, I wouldn't have lost $17,000. You guys get what I'm saying? I would not have lost 17K. But what I was doing was I was going far out expiration wise because I thought that made I was safer, right? I thought I was safer. But just because you get far expirations does not mean that you're guaranteed to hit. Because what if you get at the height of a move, right? And then the stock comes down. It don't matter what your expiration is. You may have time on your contract, but you can still lose money. And that's exactly what happened, right? So that's an example. Okay? So what we're going to do is we're going to go to the iPad and I'm going to illustrate a couple things for you guys. And then what we're going to do is we're going to go to the charts. Okay? So we got the iPad right here, right? So we got expiration dates, expiry dates, okay? So let's think about this. We got far out and we got weeklies, okay? So what are the pros and cons of these things? Far out, you do have time on your side, obviously, right? That's the biggest thing for me. You have time on your side, right? Weeklies, you have less time, but you have a bigger reward, right? And then you also have smaller gains, okay? And now the far out expirations are also more expensive, okay? And the weeklies are less expensive, okay? So let's go to an example with the options chain. Let's work with the stock here. All right, so we're going to, so I got my options chain pulled up here. So let's say we have, let's go to Google. Google has been one of my favorites this year. So, all right, so right now is Thursday. Right now, the weekly contracts, let's go to next week's contracts, right? So December 19th. So next week's weekly contracts are 500, right? $500 to $600 for weekly contracts next week. This week, they're at like one something or 200. So let's say I want to get into Google for next week. All right, Google for next week, December 19th. All right. Now, if I'm doing out of the money contracts and I'm doing weeklies, I may only have to put about $300 into a trade. All right. And let's say I want to get into Google and let's say I want to do March 26th. You see how much those are? These are $2,000. Okay. So if we do a little out the money, let's say $1,600. Okay. So if now obviously you want to know what type of move you're expecting, but if I get a weekly contract and I was going to put $1,600 into a contract, then I can get a weekly contract and I could put $600 into the contract, right? And I can make more money. Reason being is because the closer the expiration date, the more sensitive that contract is to movement, which means that you will make more money because it will move faster, right? If you get So let's say you get the same type of move. Let's say Google goes up. Let's say you're in some calls, right? And let's say Google goes up by $3. So you get a $3 move to the upside, right? With this type of contract, March 9th, we said, right? March 20th, this type of move, a $3 move, you might be up 25%. Let's say 20%, okay? 20% plus. With this contract, $3 move, you put $600 in, you might be up, let's just say 80%. Okay? Now, what's 80% of $600? That is 100% is 600. So if you divide 600 by 4, so 600, let's do some math real quick. 600 times 0.8, 480, okay? So you're up $480, right, in profit. Now, what's 20% of 1,600? That is 1/5. So we're going to divide 1,600 divided by 1/5, or we're going to multiply it times 0.2. That is 320, okay? $320, right? So you get 20% return on $1,600, that's 320. You get 80% on $600, that's 480, right? Off of weekly contracts. This is how you can make more money with weekly contracts, right? The key is to understand what you're doing and to know what moves you're expecting, right? Because just because you go a further out expiration does not mean that you're guaranteed to make money. And also what happens is when it does make the move and you only up 20%, you like, damn, why you expose yourself to more risk than you needed to, right? So if you were going to put $1,600 in a trade, why don't you just put half of that money into a weekly contract if you're expecting the move to happen over the next 1 to 2 days? And then you can 2 to 3x what you would have made on that move based on the contracts that you got, right? This is how I learned to think, right? Now, when do you get weekly contracts? So what I like to do is, so for ETFs, I love 0 to 1 day DTE, okay? If I'm scalping, being in the trade for 10, 15 minutes, I'll do 0 days. If I'm planning on holding it for a while, I may be, stepping away from the computer or whatever, I'll do a 1-day expiration, right? That's for ETFs. If I'm swing trading it and I'm expecting a big move, I may do 7 days to 14 days out, right? Now, with ETFs, I usually go lighter. I have a lighter size, all right? Next, so now we got stocks with weeklies, right? So Monday, so we're going to put scalp and day trades. So on scalps, I'm going to always choose that week's expiration. So, okay, so weekly XP. Weekly XP, right? I will choose the weekly expirations. So Monday through Friday, I will choose that Friday's expirations if I'm scalp trading that stock. Now, Monday through Wednesday, I'll use that week's expiration. And then on Thursday to Friday, I will probably use the next week's expiration, right? And a little out the money, right? A little out the money. So ETFs, I like going 0 day to expiration or 1 day. With regular stocks that have weekly contracts, if I'm scalp trading the stock, I like to do that week's expiration, a little out the money. With day trades, Monday through Wednesday, I like to do that week's expiration. Thursday through Friday, maybe the next week's expiration, right? And then a little out the money as well. That way, I'm not exposing myself to as much risk as if I was going to do far out expiration dates. Okay? This is very important, and this is a lesson that I've learned on my journey that I'm bringing to you guys, right? There's nothing wrong with being a short-term trader. Just because you're a short-term trader does not mean that you're not an investor, right? All it means is you don't like having to wait for your money when you're in a space where you can make faster money, right? What you need to learn and understand is the game, stocks, trading, right? And how to not be in a trade too long, right? Because I know a lot of times we think that, okay, if I just had more time on this contract, I'll make more money. No, your execution just has to get better. Your execution just has to get better. And this goes back to what do I always say? Know what trade you're getting into before you get in the trade. Day trade, swing trade, scalp trade. Don't let a scalp trade turn into a swing trade. You need to be intentional about these things, right? This is also how you get cooked. Okay? So, just so that we're clear and we understand, I want to recap this. Being a short-term trader, there's nothing wrong with that. All it means is you're getting your money every day rather than waiting for it. You can do both. If you see the market pulls back 8, 9, 10%, you have a separate account, you enter in your positions, and you wait for it to hit those profit targets, right? You have your short-term or your day trading account, and that's the account that you're using to flip money on a short-term basis. Then you're gonna have your account for your shares and all of that. You're gonna have your IRA and stuff like that. But when you are getting these contracts that are 3, 4 months out, and you're only gonna be in a trade for a day, what happens is you are exposing yourself to more risk than necessary. So what if you end up being down 50%, but you put way more money into that trade? That means that you're gonna lose unnecessary money, right? So if you were gonna go put, $1,200, $1,800, $2,000 on a contract that's 3 months out, just because, but you gonna get in, but you gonna get out in 2 days from now, it makes the move and you only up 20, 30%. And you're like, how are these people making 100, 200, 300% returns? It's because they're going a little out the money, or maybe a lot. And then also, they are not over leveraging. Okay? That's one of the biggest things. They're not over leveraging. They're not exposing themselves to unnecessary risk, right? Understand the game that's really being played here. And also, what if you want to leave runners, right? What if you want to leave runners on your trade, right? So let's just say you want to leave runners. If you get 3, 4 months out what's going to happen is, and they're more expensive, and let's say you can only get one contract, you either have to take profit or leave runners. Or stay in the trade, right? But if you get like weeklies, let's say you got 5 contracts, you can take profit on 3 contracts, and then you can leave 2 runners, right? So just think about it. Really think about it. So if you were going to put 2K in a trade 3 months out, take half of that, put that in a weekly contracts, and you could make way more money. And it could happen faster, and you could flip that money faster. Okay? So the same way with time frames, the smaller the time frame, the more skilled you have to be. It's the same thing with expiration dates. The shorter the time frame, the more skilled you have to be. There's nothing with giving yourself a little bit of time, but don't shoot yourself in the foot by trying to get 3 months out and then it don't really make the move, or it makes the move and then you be like, damn, why am I only up 18%? Right? So I hope that this made sense. If this made sense, let me know in the comments. Okay? If this made sense, let me know in the comments. I personally love trading weekly contracts now. I'm not afraid of them. I'm not afraid of 0 data expirations anymore. I've learned how to not over leverage and be okay with whatever happens on the other side of the trade, and that's it. Okay? So, like I always say, make sure you get up out your head, go get into this world, because your head is a dangerous place to live. All right? And also remember, the more you study, the less you worry. All right? I appreciate y'all time. I appreciate y'all tapping in. You guys all have a great day and a great weekend. Y'all stay smooth. Peace.